Hi guys, today we're gonna talk about moving averages. This is the lesson 3 of the series, the part 2 of the swing trading class, and moving average is extremely important. Alright. For disclaimer, this channel does not intend to replace any training and coaching programs. It is a deep introduction of the world of crypto trading. The series of this channel must not be considered as financial advices or contents are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. Alright guys, now the book is getting ready, and as soon as it's available I'll just share the links. Now the first one is available, you can go ahead and check it out, and this one pretty soon. Now, as I always like to start my lesson, I have this quote for you guys. Everybody's at war with different things. I am at war with my own heart sometimes. Tupac Amaru Shakur. Now, this is important because there is that well-known saying in crypto, in the trading world, in which they say, trade your plan. Plan your trade and trade your plan. I think we talk about that on lesson 2. The most difficult thing about trading is that 80 to 90% of the time you're gonna make mistake because you're given to your emotion. You do something that you did not plan, and then when you find yourself in unknown territory, then you literally don't know what to do since you already take action. So let's start with the main subject here. Now, a moving average is a lagging indicator. We talk about this that reduces the market prices fluctuation. It is a smooth version of the trend. There are 3 types of moving averages. We have the weight moving averages, the simple moving averages, the exponential moving average. This is the one that I use, and this is the one you'll probably need to use in your technical analysis, just to follow this class, and then feel free to experience anything else you want. And should be considered as dynamic support and resistance. Their values change at every candle close. Extremely useful in swing trading context. There is a lot of swing trading strategies that involve moving averages. We're gonna cover a couple of them in this lesson, but we're gonna have to get into detail in them in the part 3, because a good trading plan is not just entry and exit. There is money management part, and as you know, and there's also condition to take loss, and then trend study situation. So it's a whole package. So you need to be careful about other people selling signal, buying and selling signal, because making money as a trader is not just a question of knowing when to buy and when to sell. There's knowing when to stay away is important. When knowing how much you're gonna expose in your portfolio is important, and the unconditioned non-negotiable reason to take a loss is also very important. Now, that is an example of moving average. This moving average is in orange, and since a good technical analysis is not just line and point and drawing. The colors are also very important, and I took my time to explain you guys why you need to have an explanation, a clear explanation for everything you choose to place in your chart. So the orange in my charts, it's either the 21 or the 20. Okay, so that would be an example of moving averages, and I am coming this chart to show you how important the difference between a dynamic and support resistance. And I think that I've told you about this in the first part of this class when we covered the support and resistance lesson. A support and resistance, just a horizontal line, they don't move, they just stay here. For an example, this one that we have at 19k, this one that we have at 13k, they will never change no matter what the market does in the future. and certainly nothing in the past is gonna change this. But this moving average, the 20 moving average or the 21, over time, this moving average is actually 55k, but over time, at some point, this moving average was 19k, but after that, this moving average was 13k. But since every time there is a new candle, this indicator, this is for an example, the 21 moving average, consider the 21 last candle and choose to calculate an average price, and that average price is a point, and that point is the next direction of the line. I'm gonna try to make let me see if I can explain that. Wait. So the moving average is the calculation of moving average is something that you can actually do. If you can do it on your own, but that would requires way too much that will require way too much calculation, and certainly the computer is doing it better than you do. So you have, for an example, let's say that you are moving average 3, moving average MA. Okay, I'm taking my pen for you guys. Where is that stuff? Sorry. So moving average 3 will take the 3 last candle. For an example, let's say that you have 3 candles. One is at $50, one is at $70, and the other one is at $100. Now the moving average 3. Okay, so the first candle closed at $50, the second closed at $70, the third one closed at $100. So these 3 candles, for an example, we do not use the moving average 3, by the way. This is just for learning purposes, just to make it simple for you guys. This moving average will take the last 3 candles, the 50 plus the 70 plus 100. That will give us $220, and then it will divide it by 3. The result of that will give us a point. So every time we have a new candle, the computer makes this calculation, and it use all these points to create that line, and this is what you get, and this is what you call a moving average. Now that would be the simple moving average. There's many other calculation that can enter in context, but that would be a simple explanation. Now, as you can see, this moving average is behaving as a dynamic support, and every time there is a new candle close, these numbers right there is changing based on the last 20 or 21 candle. Now let's see if I have anything else I should explain on this one. Okay, now when a moving average is violated, a change in the trend might already be taking place. Since moving average is a lagging indicators, any important explanation that happens, it's not like our side when things happen in real time and the indicator is reacting in real time. So the moving average, has to wait for a candle close to express is technical analysis interpretation. The longer the time spent by a moving average, the more significant its interpretation. Now, I would like to add its interpretation in terms of trend. So, okay, so the bigger, so we have 50 moving average, 100 moving average. A well-known moving average in the market is the 200 moving average. The change of direction of moving average is more important than a crossover. Now, this is a clear uptrend in the moving average, so a crossover here is important, but the direction, the first thing you see when you place that stuff is the direction, because I'm gonna show you at the very end of this video the weakness of that particular indicator, but this weakness can easily be you can bypass it if you just pay attention to the direction of the whole line. So simple moving average, it is widely used. It is the average of the price over a certain period of time, and I think I'll give you some explanation about that. You'll never have to calculate them, but it is good to know how the computer managed to generate them. So that will give you an idea of what is it you're working with. Now, crossovers. Now, I should say crossovers and crossunders. That's what I should place here. Crossover is when the prices, the candles, they go over a certain moving average. Crossunder is when the price is going under it. Now, presentation of moving average going up, I should say that. Crossover can generate lots of false signal, particularly in sideway market, which we're going to talk about that. A combination of many moving average or interpretation which with other indicators is always useful. Now, this is where the real power of using moving average comes. When you associate it with other indicators, volume, RSI, MACD, whatever. Now, this is an example. This is a big, now very large example of crossover. Now, this candle is the candle that did the crossover, but this candle is the confirmation. So this is the cross, this is the crossover, and then when you have a crossover, this is not an indication to enter a trade, because the moving average is more significant for the trend. You need to use something else another strategy to enter. But now you know that the bulls are taking control. This is takeover. Now, once you have that, it doesn't matter what type of time frame it is. It is the same interpretation, weekly, monthly, daily, no matter what. So you have a crossover here, this one right there, and then you need to wait another candle. This if this is the time frame, if this is the weekly time frame, you're gonna have to wait another week. If this is the daily time frame, you're gonna have to wait another day. If this is the hour time frame, 1 hour time frame, you need to wait another hour just to have what we call a confirmation. Now, this candle here is the confirmation because this candle managed to stay above the moving average, and then this is the indication to take a long. Okay, you're gonna have to go ahead and select this zone right there and go ahead and study this zone. This zone is in a lower time frame, and to find a setup to enter a long position and place your stop loss, calculate your exposition, and then take a long position and ride this in a swing. Now, this is the same situation here for cross under. Now we have a cross under here, this candle right there. Now, this is not an indication to enter a short, but this one is. This candle right there is the confirmation. Now, this is so this would be considered as a way to enter a short position, but here's the reason why you will have not take this short. Like I told you, the direction of the moving average is way more important than crossover. When you look at this direction, this is a bull trend. So this is not an indication to short. You know what I mean? So this cross under is important in a sense that you're gonna have to go ahead and take a lower time frame and choose this time span and study it in a lower time frame just to make sure you get a better entry, and look for other setup to take a long, because when you look at the overall direction of this, but this one is orange 20 21 20, this one is red For me, it's 50 or 55. So this direction, 55 or 50 moving average, is extremely important. So I look at this direction, I know this is a bull trend. So I'm not gonna enter a short because the direction of that stuff is bullish. So I might need to go ahead in a lower time frame. Since we are in a daily time frame, maybe I will go in a 4-hour time frame or 1-hour time frame and look for a diversion on RSI. For an example, we're gonna have to talk about all these things, because what we want to do here is not shorting. What we want to do here is looking for a reason to go long. This might be a little bit tricky, because you look at that, you'll be like, well, that's a cross under, I need to short. But that's not the case, because the trend is the most important thing in this situation. In this situation, the trend is literally bullish. So this is not a short indication. If this line was red and we had a different direction, something like that, that would be a reason for you to short. Now, here you need to go ahead and lower entire frame and look for particular bullish setup, bullish diversion in any of your favorite indicator. All right. Now, important combination. Now, moving average plus a trend line violation. This is the first one we're gonna go ahead and look for. Generally, these two events in the short like to confirm each other. And very interesting, guys. If you have two of these things, they talk. If they telling you the same thing, you supposed to pay attention to that. If this happen against an important position, take the loss no matter what. As soon as possible, sorry. You can make way more money in the new trend 90% of the time. Now, I need to explain that real quick, and many people don't get it. See, in the trading world, see, the profit if you don't make a profit, so the profit you did not make is also a loss. All right, but there's one thing you need to understand. If you fail to take a loss, if you take a loss earlier, it is also a form of profit. Let me explain my point. Now, if you see this one right there, you have a channel. We did cover the lesson about channel in the part 1 of this class. And then you have a moving average. This is just Ethereum 4-hour time frame, and this moving average is the 20 or the 21. You have a break of the channel here, because this channel have been reacting here somewhere. These are all reaction here. We did try to go through it, but take a look about the moving average. The moving average literally stay inside of the channel, but this is an important situation. You have this first candle right there, it cross over it. Now we're waiting for a confirmation, right? And then you have this second candle right there, it confirms the new trend. In addition to that, you have a channel that have been broken, and a very important one, because you have 1, 2, 3, 4 reaction. So this setup right there in a 4-hour time frame is the reason to enter long. Let me try to explain how you can associate those events. Let's say that we're gonna forget this is Ethereum for a moment, but we're gonna keep the time frame. Okay, let's say that you saw this in a daily time frame on Ethereum. We have a drop. This is a bull trend on a 4-hour time frame daily, and then you go in a lower time frame and you have this situation. So when you study this zone right there in a lower time frame, let's say it looks like that. Now this will be a situation to enter long, because the daily time frame is bullish, but we are having a small correction in a 4-hour time frame, and this is a situation in which you enter a long position. You have this, you look for a long in this zone right there. See what I mean? That would be another example of crossover with the same thing here, same situation, a channel. You have a reaction here, reaction here, reaction here. Okay, you have a reaction here, reaction here. The bull, they try to maintain the reaction here, but it did not happen. But we have another reaction here in the other side of this line. So we know that this is going down, but in addition to this uptrend violation, we have a moving average 20 or 21 did go through that trend line. So this entire thing is bullish, but this thing right there literally tells you that there is no more bull trend. It's a change of the direction. I have more example for you guys. Okay, this is the same situation. So you would have take a short here and then close it somewhere here, or looking for to close it somewhere here. That's another moving average crossover plus trend line violation. This one is interesting. This is Binance coin. You have 3 reaction, and this downtrend line, you know that if it's green, this downtrend line is on a daily time frame. So the moment this downtrend line have been violated, this downtrend line is not a dynamic support and resistance. This is a static. That is the difference between this trend line and the moving average. This is static, but this one is dynamic, in a sense that every time we have a new candle, this moving average that behaves as a support and resistance is changing its value every single candle. Now, if you can pay attention to this right there, we did a crossover and then a confirmation over the trend line, the static trend line. The moment we are over it, we keep having rejection all over here. These are all rejection from the bulls, but the most important thing is that in addition to this downtrend line violation, you have a crossover of the 20 moving average. Now this is where you take a long. Okay, this is where you take a long. Another situation, that would be a 4x chart, daily time frame, USD dollar and Japanese yen. You have one touch approach, that's an approach, not a touch, another touch here. This is extremely important. That's a strong daily downtrend line. So you have the same situation here. You have this candle, did the crossover, then the cross, and then following this candle, you have a change, a violation of that same downtrend line by this moving average here, which is usually 20 or 21 on my chart. So this right there is telling you that this is bullish. Look for a strategy to enter a long position. Now you have another one. This is the moving average violation with volume surge. I personally like to look at for them when I spot a pattern like triangle. Very important, because triangles are made of 2 trend lines, right? And head and shoulders, same situation, they have trend lines in them. And the part 3 of this series, I'm gonna teach you how how you can use strategy to identify breakout a few candle before it happens. This is interesting. Some traders, they told me that it's impossible, but when I show them this strategy, this is in trend. This is gonna blow your mind 100%. I'm just gonna keep this as a promise. We use the moving average, volume, and the pattern in question. It can be a triangle, it can be a channel, it can be a head and shoulder, something like that, or just simple moving average, uptrend line or downtrend line. So we're gonna have to go over this now. Trend violation. Now take a look at this volume right there. We have a spike in the volume here. we have a downtrend line, the same shot. This is the same shot here. I just add the volume indicator. We have a spike in the volume. We have a violation of that trend line, because this is clearly a strong downtrend line. We have a violation plus confirmation, and then you have a spike in the volume here. There's nothing more bullish than that in this chart. In this entire chart, this is the most bullish zone, and then you would have certainly looking for go, for an example, go lower 4-hour time frame in 1-hour time frame, in which we usually take action, and then look for a setup somewhere here, maybe a extreme oversold in 1 hour, 4-hour time frame, maybe a head and shoulder, anything that is pointing toward a reverse in the trend 4-hour time frame, and then you ride this boy all the way up. Another one right there is let me see. Okay, so that's a big spike in volume. Very complicated chart, I'll give you that, but this is that's a whole chart. We don't have these prices anymore, but look at how important the correlation between this violation. This is I think this is 2018, so we are literally in a bear market. I remember this bear market in cryptocurrency. So this is a bear market of 2018. One of the first bear market, one of the first, and probably the one that I love the most in cryptocurrency bear market. So this one right there, you have this violation followed by this surge. I did point out this one, but this one is probably the most important one. That will be a 43% drop in the price. An interesting way to enter a trade or short. Now this one is important here. I wish I had the bigger time frame for you guys, but in the bigger time frame, I think we had the outer indication for a long, and then that would be an interesting reason to enter a small long position here. But you have a spike in the volume, a violation of the moving average. This is a daily time frame. A small trade here, only here, would have give you like 22% profit in one trade. A short here will like give you like a 43% profit here. Now, all right, that's another one. We are still in the that's the 2014 bear market. So that's bear. So that is bear 2014. Okay, and weekly time frame, very important downtrend line. That was the most important downtrend line in the bear market of 2014 in Bitcoin. And then you have this candle, important first crossover. This one, not this one. This one, and then that's the first week, and then the second week we have a confirmation. The moment this candle closed, we had a point here in the 2021 moving average, followed by this point here. This lapse of time is the most important point, because that is literally the beginning of the 2017 bull market. I think the price of Bitcoin was around $200 something. If you did enter here, you will have ride Bitcoin all the way up to 19k, and that's a massive gain. Since you consider this is in the very first slide of this presentation, I told you that the bigger the time frame, the more important those moving average. So you need to understand moving average. Take the time to understand moving average, guys. But here's the most important thing. This spike right there is the biggest we ever had for 2 years. This is 2014, 2015, and almost 2016. In 2 years, this is the biggest spike of volume. This is a closer. That's a big picture. Take a look at this. This is the highest spike of volume we had in more than 2 years. And this was literally the end of the bear market of 2014. exactly have $250, and you would have, buy that stuff here and probably ride it all the way up. Take a look at this spike here, this violation here. Just by using this simple strategy, you will have entered at $250 and probably close at 11k. Now there is other situation you can close higher, but just pay attention if you just follow this simple lesson and then you decide to use this only strategy. You look for this break, trend violation, break violation, spike, and then you ride that stuff. This is the weekly time frame, so we're just gonna keep riding it. And overall, as you can see, the 20 moving average is behaving as a dynamic resistance. This understanding of moving average only can make you lots of money in the market. Now, the downside of moving average, because every time you choose an indicator, you need to know what is the weakness of that particular indicator. And sideway market is the biggest weakness of moving average. If you're using moving average in sideway markets, you are guaranteed to lose a lot of trade. It is very important to know when we are dealing with them in order to switch strategy or simply stay away. So I prefer to stay away, but some people, they flip from swing to scalp in any times, because scalpers and day traders make more money in sideway market than swing traders, because there's no real swing in a sideway movement. That's an example. This is a 20 moving average. This is Bitcoin daily time frame. Now think about it. We have 137 days and 16 crosses, not crossover, 16 crosses. So imagine we've been there. Look at all these crosses. There's no real gap enough. There's not enough gap here to make money. So you have all these crosses in a sideway, and this sideway movement lasts like 137 days. So it's like half of the year. So you need to understand this and using other indicators to identify those sideways, because this is the weakness of moving average, and literally every single one of them. It doesn't matter which one. As another example, 15 crosses, 20 moving average for like 72 days, same thing. So maybe you were thinking, it's just cryptocurrency. Nope, it's the same thing in every single market. This is a Tesla chart, weekly time frame, 20 crosses for 90 and 95 days. That's literally 2 or 3. That's almost 3 years, guys. Almost 3 years. And during this time, people that are make money, they are either day traders or scalpers. This is not interesting for swing unless you go in a lower time frame, 1, 4, and daily time frame. But take the point here is that we start a sideway May 2014 on Tesla, and the sideway literally ends 2 years after. 2 years sideway. So if you've been using this strategy on this particular time frame, I don't think you would have been very happy with it. Just another one. This is 4x, because I wanted to show you the same situation in different market. And you have 28 crosses, 28 moving average, and a scalper gonna make a lot of money in this. Like I told you, that's literally half of the year. They're gonna keep making money, and that's the reason why in a market or an asset that tends to have a lot of sideway movement, scalpers and day traders, they love them. Now, moving average selection. Okay. What moving average do we select when you're using them by sets of moving average? Your selection of moving average really depends on the market and the market cycle. A low moving average, like anything under 5 days EMA, is too sensitive, and over 4 year they do not react at all. So you need to stay between 10 to 200 or 400, but these are my selection. You need to stay between 9 days moving average and 400. That is decent, but I suggest that you use the same that I use, and then after that, if you understand and master the subject, just go ahead and do your own experience. I strongly recommend that you go ahead and develop your own strategy. Now you need to select moving average that are well known. Very important. Don't go ahead and use 25 moving averages. It's like most people do not use them. If you use a moving average that is not well known, that is not well used in the market, you're gonna have support and resistance that nobody is actually using. You're gonna have a signal that nobody will see, and it's better that many actors in the market are doing the exact same thing. They are reacting to the exact same technical analysis in the market. So use some that are well known in the market is important, like 21 is also well known. The 9 moving average, 50 or 55, 99, 100, and then this one right there. I think everybody who call themselves a technical analyst has a 200 moving average in their chart. If they don't have it, they use it. Now use moving average with big value and any big time frame. They are less subject to manipulation, helps you stay more consistent because they give less signal, if we're gonna say it like that. They lower your number of trade, therefore lower your fee and overall limit your risk. So when it comes to moving average selection, what moving average do we select when using them by sets of moving average? Some traders use one moving average, some use a set of moving average. I prefer when you use a set of moving average. So your selection of moving average depend on the market and the market cycle. A low moving average under 5-day EMA is too sensitive, and over 5 years it won't react the way you would like it. Now say you stay between 9 days and 400 is decent, but these are the most used moving average in the market. Sorry, 20, 21, the 9, 50, 55, 90, 90, 100 and 200 moving average. So when you use moving average with big values, 15, 99 and 200, they are less subject to manipulation, help you stay more consistent. They lower your number of trade, therefore lower your fee, overall limit your risk. So the more you make action in the market, the more action you take, the more risk, the more exposition you take. So big moving averages, they kind of prevent you from over trading, which is a big problem, especially when you are new to trading. Now in this case, we're going to select 5 moving average. I do not always have all the 5 moving average in the chart, but these are the 5 moving average that I usually work with. They can be part of different strategies. Sometimes I place 3 of them, sometimes I just place 2 of them, but it really depends on what is it I'm looking for. So we're going to select their color based on the market hierarchy that we talk about since the very beginning of part 1. Same color, same signification, because I truly know that you're gonna go ahead and find it very interesting. I used to be beginner, but when you have a significance, when you can use all the tools in the chart to help you understand the overall condition of the market, it can be very useful. Now EMA selection from the strongest, and this is exactly how you need to place them in your chart. Sorry, you need to place 200 moving average is the one in white color, 99 100 green color. I use the 100, the 50 or 55 red always, and the 2021 EMA is orange. I use the 20, and the 9 or the 10 I use the light blue. I use the 9 usually on my chart. Now if you have been there since part 1, you probably realize there is a similarity between the selection of my color and the trend, the trading style, and the time frame we use. So we won't go over this again. So if you want to understand this a little bit better, you can just go ahead in the part 1 and go over this again. So I'm not gonna repeat myself because there's way too much information. Now I live in Florida, and almost every year we have storm, and then they use this forecast in weather. So if you've seen this in forecast in tropical storm, they call this a spaghetti plot. They use this a little bit just to use different algorithm, different presentation, so you can have the European version, the American version, and then overall they can go ahead and plan about the trajectory of the particular storm, the different algorithm, different parameter, but same logic. In both situations we have an idea of what we can expect in terms of direction. So it's kind of the same thing when you're looking at moving average. Okay, so you can go ahead, this is exactly what your chart should look like, and then you'll have an idea. So this is the 200, 100 or 99, 50 or 55, 20 and 9 or 10. Now when you see this composition, it doesn't matter which time frame you're going on, the disposition of this moving average wheel tells you about the direction of the market overall. Now that's another example, daily time frame, and you can see clearly this zone right there could be considered as this zone of fanning right there can be considered as the beginning of a trend, and then you can expect a drop here, and that will be a short. Same situation here, and same situation here too, and these, they literally behave like the spaghetti plot slide that I show you when they use them to forecast a storm. Now one thing you need to understand, and I need to tell you, is that those moving average, they react like they are, just like I've told you example, they react like they have different powers. Of course the 200 is more stronger than the 100 and the 50 and the 20 and 9, and then the way they react is that this entire thing is stronger is going this direction right there, if I can say it like that. Let me get my pen. So this entire thing behave like some kind of block of support all over here, and then the deeper you go in that support and the stronger the resistance is, and the more significant it is. So for an example, when you have that cross over here, it means something, but when you have this crossover here, it means something. This is more significant, this is more significant, and this is definitely more significant. So when the 200 moving average managed to push back the price, it can be a violent push just the way it is, but the significance of crossover here is way more important than one here, for an example, in a sense that this moving average consider at least 200 days, because 200 weeks, because this is the weekly, while this one right there only considers 7 weeks. So that's the reason why these moving average, they have different strength, the 200 is more stronger than the 9, and that's the kind of logic you're supposed to have in your mind when you're looking at the short in the market. Now, if you did establish the link between our selection of color and the trend, you realize that, just like I select the color, the way that these colors, this position express the same reality. So 200 represent the investor decision, very important. 99, 100, 50, 55 swing traders decision. It's these moving averages, they are extremely important for swingers, and we're probably gonna have to go over this too. And then the 209 is the front line, where all the nasty things are happening. Day traders, scalpers, chopping up each other. So I place them just to have an idea, but I don't really use them exactly. Now later on part 2, we will use a laddering technique to build strategy that heavily involve moving averages. Now, principle when building strategy involve moving averages. Now, crossover must always be confirmed using another indicator. I use another indicator. The confirmation with the candle is extremely important. For an example, you have price and moving average crossover. So I think we did go over this. So you have moving average crossover and cross under, important. And you have moving average and trend line, crossover and cross under. So we did go over this broadly. So moving average placement are a good indicator for trend. Now, placement by placement, I mean a moving average like this. Since this is red, this is the 50 or 55, means something, versus moving average going like this, or simply someone staying like this. They are expression of the overall market trend. Now, the same moving average on a big time frame is more significant than a smaller one. For example, moving average of 55 in a 1 hour time frames is way different than a 55 in a weekly time frame. A trading strategy can use one or more moving average. Moving average are useless on sideway market, and I think I've told you that. So many of their crossover just give you too much crossover. Now, major important crossover: the price moving average 55 and the price 200. Now, the price 55, I think we're gonna have to talk about that a little bit, but this is a very important crossover for swingers, and this one is extremely important for investor on a daily time frame. You will hear terms like the death cross, for an example. So the death cross is when the price cross under the 200 moving average on a daily time frame. This is a very, very significant pattern, especially from an investor's perspective. So moving average, you have the 99, 100. This moving average is extremely important, and there is a very powerful strategy that I'm gonna go in detail when we go over them in the future. Now, price 55 crossover. Now, this is one of the well-known swing trading strategy. It's very simple, and first you do your trend study, just like I always tell you. You start from the bigger picture weekly to establish what direction to trade, and then a candle that managed to open and close over the 55 is bullish signal. A candle that managed to open and close under 55 is a selling signal. Now, it's very important that these conditions must be in accordance to the trend study. Okay, many traders they don't consider that point. Let me give you an example. Now, if you are following the 55 moving average on a 4 hour time frame, and then you have this particular setup right there, if the market is bullish, this signal is more important versus if the market is bearish, because you will have situation in which the candle managed to open and close over it, but if it's in a bear market, it means something's different. It doesn't mean you need to buy. Maybe that would be a situation in which you look for a bearish diversion. Use like in a 4-hour time frame, you go a little bit lower in the 1 hour and look for a bearish diversion using a different or coincidence indicator like RSI, so you can look for short. That is if we are in a bear market. But if you are in a bull market and you have this, then you probably need to go in a lower time frame like 1 hour and look for a situation to enter a long position using a retracement, for example Fibonacci or that kind of stuff. So I'm gonna show you how to work all these things when we done going over every single major indicator. I'm gonna show you how to use them in correlation, just many of them at the same time. Just you can go ahead and pick a signal from one and then use another one to confirm, and use another one to enter, look for entries, the way that we usually work them. Now this strategy offers good entries on 4-hour time frame, like I already told you. So we have a short here. Now the red moving average, we know this is a 55 or a 50. It doesn't really matter. Now when you look at that, for an example, this is clearly an uptrend. So with that being said, this is a Tesla chart and a daily time frame. This is clearly an uptrend. Now I'm not gonna really look for short here, for an example. I'm not gonna short that. There's no question for me to short anything here because the trend. So after the trend study, this is a bull trend. So bull signal are more important. Now you would have buy Tesla somewhere here and make 170%. Probably look for a reason to reduce your position, because this is a red line. This is a white line right there. So this is probably a weekly resistance. Not probably. This is a weekly resistance. That all these colors didn't really mean something in the short, and I did go through this very systematically in a way that you can understand everything in this chart so far. So that these lines are from the weekly time frame because they're white, and then this is the overall trend. The overall trend is bullish. So this signal right there is where the money is. But you would have never care about this, don't really care about this one or even this one, because this is a bull trend, and those signal you just don't care about them because we're not shorting a bull market. Same situation in which you're not supposed to go long in a bear. Just go ahead and keep shorting whatever. If this was the inverse, that's exactly how you should behave. Now there is another one. This is a price crossing the 200 moving average. Now the 200 moving average is a non-concrete block. This, every time the price is messing up with the 200 moving average, you need to pay attention to that. It cannot be used to enter and exit, because the bigger these big moving average, they do not react fast. In a sense, moving average in itself is an indicator that is a lagging indicator. So the 200 is very slow in terms of reaction, but it is extremely important. In any given time frame, it is simply a bad idea to trade against it, because it will probably, and most of the time, the 200 moving average will probably set a new trend most of the time. Now the depth cross, like I told you, is when the price is crossing down, the 200 moving average on a daily time frame. because death cross on a daily time frame is the one that most investors are looking for, especially to consider, is it heading toward a bear market or bull market. Very important cross. Now this is one example of death cross, daily time frame. Google death cross, and we are in I think it's I cannot probably see the date, but that was a crisis. Yeah, that was a crisis. So this is the cross, this is the confirmation, and this is the bear market. And then when we had that, and investors know that was the end of it. But there is a way to behave here, and there's another way to behave here that we're gonna have to talk about that, since now we are doing a descriptive approach of every single indicator. Some other crosses like 55.99, there's a very interesting strategy in this thing. Very systematic way to do it, very disciplined way to enter. It's a perfect set to look for entries. I know that because I've been making lots of profit, but this is a strategy that we're gonna have to sit down and study in real depth. When trend is bullish, use it to buy on retracement 4-hour time frame. I would say when trend is bullish on daily time frame, so if you have 55.99, something like that, so that would be the 55 and the 99 on daily time frame. This thing is like a block support. It's like a support block, and then you can trade you can trade over it easy. I gotta do it in a way that makes it more easy for you to grasp. So you have the 55. Okay, you have the 55 like this, and then you have the 99, usually something like that. Okay, so if you see this on a daily time frame, this entire thing is a support block. Okay, so as a trader, you can just go ahead and have fun trading back and forth, using the 20 moving average and riding this thing up. So it's a little bit like that. The colors are very significant and they all mean something. So I will teach you the setup, because there's different one. This is one of the best way to enter a swing that I personally know, like one of the best, especially when you were late, you did not catch the swing at the moment it was happening. So that would be an example, just exactly like I used to, just like I said in the example. I did not place the 20, but like you can see, when the 50 and the 90 cross and they all get together and they cross that 200, this is what I call, I don't think you will see that in any book, I haven't seen it in any book, this is what I call a trend triangle. So you see this on a weekly time frame, this stuff right there is bullish. Consider this as a bull trend on this particular asset and never short it. Just look for long until you have another triangle in the other direction, just like this one, just like this one right there. Okay, so every time you see this is like a seal. Just see that stuff, just seal the trend. The trend start here, of course, but when you see this, the trend have been sealed. It's set to go up. Give you another one. That would be an Ethereum trend, and the 200 moving average is not there, but this, for an example, will have been a situation for you to enter a trade here, and just like I've told you, this is for a trend. Now remember, guys, this is not signal to buy. There's different way to enter these trades, but inside of this thing right there, you know what I mean, this entire thing is a support block. all the way up there until until there. Now this is not an indication to exit the trade, but it's just for me to explain, just for you to understand this entire thing right there is a support block, and when it cross under, it turns into a resistance. Now this will tell you clearly we are in a bull trend, and then you need to go ahead and pull your entry strategy on a lower time frame, so you can go ahead and look for a long position. Now cross 920 over 55. This is a little bit closer to day traders than swing traders, but it's also part of swing trading also now, but most, it's like in between swing and day trading. It could be considered as a variation of the price 50 over cross, but it has a better behavior on sideway and offer better exits. Now it's now it's a set of three, so you have the 20, 50 and 100 or 99, as you can see this. So we are in a 4-hour time frame, and as you can see, there is a trend line that I placed here, so these are the entry for 29% profit, another one. But like I said, this one right there, this particular setup is a little bit closer to day traders than swing, because most of the time you're gonna have to exit an entry, but that will be a good way. This strategy can be used to exit a previous long that you did enter using the 55.99. So you can use the 55.99. For example, you enter a 55.99 here, and then you exit the 20.50 here, just for more trade. But it's still closer to day traders, and it still gives you way too much entry and exit, to my opinion, to be a real very specific swing trading strategy. But it's an interesting one that I think you should be aware of. So and then after that, you have the 99-200. Now this cross, the 99-200 crosses, this cross can be part of an investing strategy for long-term players. Investors like to buy when the market is extremely pessimist, but they sell when everybody is euphoric. That is true. It is a totally different approach. It takes time. It requires lots of patience, honestly. And don't lie to yourself. You're not an investor if you're taking action more than 2 times a year in the market. See, even in stock market, if you buy and sell a stock in less than 1 year, they're gonna tax you differently, because this is not considered as a long-term hold. So we won't discuss too much detail here, because like I said, this is a descriptive approach of moving average in every single indicator that we're gonna talk. And next indicator will be moving average, conversion divergence. We're gonna cover RSI, we're gonna cover volume, we're gonna cover many well-known indicator, and then in the part 3 of the class, we're gonna go ahead and teach you how to use them in accordance to each other. Okay, so that's it for this lesson. Let me remind you that this channel do not intend to replace any training and coaching program. It's a deep introduction of the world of crypto trading and stock trading too. The series of this channel must not be considered as financial advices. Our content are only here to educate, inform, and entertain. Trading can be very risky. Only risk money you can afford to lose. Alright guys, see you in the next lesson. Take care. Bye.